The crashes that redefined risk. It always begins the same way. Quietly, almost peacefully. A subtle dip in the market. A hint of unease. A moment when investors glance at their screens a little more often than usual. No alarms. No panic. Just a shift in the air. But behind that shift lies the opening chapter of a cycle that has shattered assumptions, rewritten fortunes, and forced the world to rethink what risk truly means in the age of digital money. Today, these crashes are etched into cryptocurrency history. They serve as warnings, lessons, and turning points. But to understand why they mattered and why the ecosystem keeps surviving them, we must revisit the moments when the market fell not by accident, but by gravity of its own ambition. Because long before each collapse made headlines, the foundations of those crashes were already forming. It began with overconfidence. After months of rising prices, investors grew convinced the climb would last forever. Newcomers entered the market believing volatility was a myth, a relic of early crypto days. Veteran traders felt uneasy watching history repeat itself. Patterns of greed, momentum, and denial building layer upon layer until the balance could no longer hold. The reveal came when a sudden drop cut through the euphoria. At first, it seemed harmless, just another correction in an otherwise unstoppable uptrend. But the dip deepened, panic spread, order books thinned, support levels crumbled like sand under a rising tide. Markets that had once soared now plunged with breathtaking speed, pulling the entire ecosystem into a downward spiral. Yet the true story of these crashes wasn't in prices. It was in the reactions. Exchanges halted withdrawals. Investors scrambled to liquidate positions they once swore they would hold for years. Online communities filled with fear, confusion, and disbelief. The same voices that had celebrated endless growth now questioned whether the entire experiment had finally reached its breaking point. But the deeper question lingered beneath every crash. Why did a movement built on resilience feel so fragile in moments like these? And how could a technology strong enough to reshape global finance be shaken so violently by human emotion? As the market plunged, the illusion of stability dissolved. What looked like a smooth ascent was now exposed as a structure held together by emotion. Fear on one side, greed on the other. With every drop, the panic accelerated. Stop-loss orders triggered in rapid succession. Leverage positions collapsed. Liquidations cascaded across exchanges like falling dominoes. The architecture of modern trading, designed for speed, amplified the downturn instead of absorbing it. Yet the external mechanics told only half the story. The deeper unraveling happened within the community itself. New investors, unprepared for the violence of crypto cycles, watched their enthusiasm turn into shock. They had entered the market during moments of celebration, convinced they were participating in a revolution destined only to rise. Now, faced with losses they never imagined possible, many felt betrayed, not just by the market, but by their own expectations. Veteran participants recognized the pattern. They had lived through crashes before, each one carving lessons into the collective memory of the ecosystem. They tried to warn others, but warnings rarely travel faster than excitement. And in the chaos, their voices struggled to be heard above the noise of fear and speculation. The cycle of disbelief repeated itself block by block, hour by hour. Outside the crypto world, traditional institutions reacted quickly. Analysts declared the end of the digital currency experiment. Commentators insisted that volatility-proof crypto could never become a real store of value. Regulators issued statements of caution, while central banks reminded the public of the risks of unregulated markets. Each headline added another wave of uncertainty, feeding the storm already raging in the charts. Meanwhile, technical strains emerged. Exchanges buckled under record traffic as users rushed to react. Networks slowed as millions attempted to move their assets at the same time. Fees spiked. Frustration grew. Some investors found themselves locked out of their accounts during crucial moments, watching helplessly as the market moved without them. Each failure, whether technological or emotional, deepened the sense of instability. Yet, within this turmoil, something unexpected began to happen. Developers continued to ship updates. Miners kept securing the network. Builders in decentralized finance and Web3 quietly pushed forward. The crash revealed a divide between price and progress. Markets fell, But innovation didn't stop. Even as fear gripped investors, the infrastructure continued to evolve. Still, the emotional damage lingered. For many, this wasn't just a financial loss. It was a shattering of belief. The same energy that fueled bull runs now fed despair. Questions emerged in every corner of the ecosystem. If crashes were inevitable, could the system ever stabilize? Could volatility coexist with legitimacy? And why did the crashes feel more human than technical? As the decline slowed and the chart found a temporary floor, the world braced for what would come next. The panic had revealed vulnerabilities that price alone couldn't explain. Risk had taken on a new meaning, one shaped not by technology, but by the psychology of millions moving in unison. And beneath it all, a much louder question began to echo. If the system could survive destruction this severe, what did that say about the future waiting on the other side of the crash? As the crash deepened, the market entered a phase that felt less like a financial event and more like an emotional reckoning. Prices continued to fall, not with the sharp violence of the initial plunge, but with a slow, grinding persistence that tested the patience and conviction of even the most seasoned participants. Every attempted rebound failed. Every rally dissolved. Hope thinned, replaced by a quiet dread that whispered the same unsettling thought. Maybe this time, the recovery wouldn't come. The conflict reached a new intensity as the community fractured into distinct camps. Some insisted the downturn was temporary, a cycle as old as cryptocurrency itself. They pointed to past recoveries as proof that innovation would triumph over volatility. Others believed the crash signaled a fundamental flaw in the system, a structural weakness that no amount of optimism could ignore. Their discussions turned somber, filled with unease rather than certainty. Investors watched their portfolios shrink to fractions of their former value. Screens that once displayed celebrations now reflected regret. Online spaces that had thrived on enthusiasm became battlegrounds of frustration and blame. People questioned not only the market, but themselves. Why they entered, why they stayed, why they ignored the warnings. The emotional weight grew heavier as the downturn stretched from days into weeks, from weeks into months. Meanwhile, external pressures continued to mount. Governments tightened their scrutiny. Banks issued stern reminders about the dangers of unregulated assets. Media outlets amplified stories of catastrophic losses, turning individual misfortunes into headlines. The narrative shifted from curiosity to skepticism, from excitement to indictment. For the first time in years, the world wondered whether cryptocurrency's promise had been an illusion built on speculative enthusiasm. Inside the ecosystem, builders pushed forward, but their work felt overshadowed by fear. Projects struggled to secure funding. Communities shrank. Developers questioned whether their innovations would survive the fallout. The energy that once fueled creativity now fed doubt. Yet, even in the silence of bear markets, breakthroughs emerged, small, steady signs that the foundation was still evolving beneath the rubble. The emotional peak intensified when the market reached levels many believed were impossible. Assets that once symbolized hope now carried the weight of disappointment. Long-term believers faced the sobering reality that conviction required more than slogans. It required endurance through darkness. And newcomers confronted the harsh truth of volatility, learning lessons that could never be taught in times of euphoria. Yet within the despair, a subtle shift began. Conversations changed. Instead of asking when prices would recover, people asked what they had learned. Instead of chasing the next rally, they sought understanding. The crash, in stripping away illusions, revealed something the bull markets had concealed. The resilience of those who stayed, who continued building, who continued believing not in charts, but in the potential of the technology itself. Still, the pressure remained. The market had not yet bottomed. The community had not yet healed. And the world, watching with a mixture of fascination and caution, sensed that the next chapter would determine whether the crash marked an ending or a transformation waiting in the shadows. The turning point arrived quietly, almost invisibly. After months of relentless decline, the market finally stopped falling. There was no dramatic rebound, no sudden surge, just a stillness that felt unfamiliar after so much chaos. Prices flattened, volatility subsided, and in that fragile calm, the first hint of recovery began to take shape. The climax of the crash was a moment of destruction, It was the moment people realized the destruction hadn't broken the system. Blocks continued to form. Transactions continued to settle. Developers continued to build. The technology that had inspired millions was still intact. Even if the optimism surrounding it had been shaken, the crash had tested the ecosystem's foundations, and those foundations had held. As confidence slowly returned, something remarkable became clear. Crashes didn't define cryptocurrency by their violence, but by what happened afterward. Each down and exposed weaknesses that needed fixing. Each collapse sharpened understanding. Each moment of fear pushed the community to evolve, restructure, and rebuild with more resilience than before. In this way, crashes weren't just cycles, they were catalysts. Reflection grew during the recovery. Investors who survived the storm emerged with deeper clarity. Builders found renewed purpose. Skeptics reconsidered their assumptions. The world began to understand that volatility was not a flaw. It was a cause of pioneering an entirely new financial frontier. Risk wasn't something to eliminate. It was something to navigate. And as the ecosystem regained strength, a new perspective took hold. Crashes did not signal the end of the experiment. They signaled the growth of an idea powerful enough to withstand fear, speculation, and skepticism. The people who stayed, who continued building through the darkest phases, became the unseen architects of the next era. In the end, the lesson was simple. Resilience is not proven in rising markets, but in surviving the storms that follow. And each time the world believed cryptocurrency had reached its breaking point, the technology emerged stronger, wiser, and more unshakable than before. Subscribe to join the journey.